Welcome to the Predictive Playbook. I am very happy, and so is Steve, that you've chosen us to learn a little bit about the bond market. And a lot of people think the bond market is just boring. Well, I'm here to tell you firsthand, after 20 years of Wall Street experience, it is the first thing from boring, and you can make a ton of money and lose a ton of money playing around with 10-year and 30-year bond futures. Now, first off, there is a lot of arbitrage. Now, arbitrage means you're simultaneously buying and selling like securities, which the treasuries are. They're homogenous. So in the pit days, when we had all those guys screaming at each other, which I was part of, there was a spread called the NOB spread, N-O-B. And what that is notes over bonds. So that would be a special price in the pit based on where the 10-year was trading and where the 30-year was trading, so you didn't have to do both separately, and it created much greater efficiencies. In the cash markets, which are then reflected in the futures market, there's a term, and we're just going to mention the term for today, but it's a very important term to write down and perhaps study between now and the next bond show that Steve and I do, and it's called McCullough duration. And what McCullough duration is, it's the weighted average term to maturity of the cash flows from a bond. So the weight of each cash flow is determined by dividing the present value, almost like a present value of annuity, of the cash flow by the price. So what that does is that then makes all the treasuries along that yield curve, from 2-year notes to 30-year bonds, you can make them equal to one another. So for a broad example, I'm working for a hedge fund or an endowment fund. This would be very common in the endowment fund. And we think that the spread between the 2-year and the 10-year is going to become more narrow. So as of right now, looking at Bloomberg here, I did have it here. Here it is. The 10-year government bond right now is yielding 1.18. And the 2-year is yielding 0.18. So you're exactly 1 percentage point. But if a institutional client came to me back in the day and said, you know what, John, I think that's going to flatten. That means it's going to get less than 100, and the yield on the 10-year is going to get lower faster than the 2-year note is. So what McCullough duration then does is it makes the weighting between the two securities exactly the same, so that you are actually getting that kind of movement. Because if you don't, you can have a situation where if the 10-year drops a lot and the 2-year doesn't, you can be completely not weighted properly. And I hope I described that right. But there is a spread called the NOB. There was a spread called the FOB, which was the 5-year over the bond futures. There was nothing for the 2s to 10s. There was no term for that, but you could do it. But anyway, Steve, I hope I didn't get too out there on that one, but something I'm very familiar with. I've done probably thousands of trades involving what I just said. So now we're going to take a look at the note here, and that is a textbook engulfing candle. The red candle that is right here, it's one of my favorite ones to see. New high in the trend. Low is lower than the previous day's low. And if we could get a close below yesterday's low, that would make it even more powerful. And this is a bearish signal. So I'm going to turn this over to Steve now to talk about why this is maybe a good time to consider. If you're looking for a refinancing, Steve's going to tell you why that might be a good idea to do now.
Yeah, I mean, first of all, this is the 10-year on the futures markets. This is ZN. Start trying to use my Zulu. Couldn't remember that. I'm trying to use my military alphabet here. November.
I love it.
Did not know November was in, John. Did you know that one? November. I don't think I've ever heard that used. Zulu, I do think I've heard used. And N is actually one you got to use because M is Mike, N is November, and those are two that sound alike. So this is Zulu November is the 10-year note as we're doing this. So we bring sports betting into it. We bring financials. Now we're bringing the military into it. So I love it. We're morphing the show as we speak.
That's
And
it.
I've got my American flags in the background for a reason, obviously, and of course, always keep one on the side just in case we need to grab one quickly during the Olympics. But yeah, the 10-year is the one I follow the closest because people always say, how do you predict mortgage rates? And it's a complex soup. But the number one thing that most closely simulates the way mortgage rates move, both refinance and new home buys, is the 10-year note. And let's keep in mind, let's make this even more confusing than it is already. When the chart is going up, the rate is going down. So it's an inverse of what the chart is saying. So and even for me, that's tricky. When I look at this, you're like, oh, rates are going up. No, rates have been going down the last couple months because the bars are going up. And because think about it, because when you're buying the note, it's worth less now because someone could buy it at a better rate. So that's why when the price of it goes up, your interest rate is going down because you've already owned it theoretically in the past. I guess is somewhat of the simplest way to put it. But
yep,
the 10-year is closely tied to the refis. Now that's not end all be all. Something else that you have to look at is kind of the overall economy and supply demand and whatnot. But that other piece of the puzzle also. So first of all, the rates have been getting better the last couple months. In fact, they're about as good as they've been back in January and February, and then the note dropped the last 5 months, which meant the rates went up a little bit. But now the exact opposite has happened the last couple months. Once again, the 10-year note price is going up, which means interest rates are dropping. They're back to pretty much where they were in that February low. So I think this is about as good as we've seen. And it does, as John just said, it looks like this market is turning over now. And by the way, the big picture chart you had up earlier, go back to that slide you had before, the longer term one, if you can, because if you notice, there's a gap about a year ago, and it fills that gap. Where we are right now is basically filling a gap from about a year ago, right there. See the one around the middle of the screen? Look at that. We've gone all the way back up and filled it, which is a textbook example of what often happens. Also, if you look at the November or the April 2020 high, which was the interest rate low back a year and a half ago when COVID hit, we've done almost a 50% retracement. The note was like 137. It got down to 130 this year. Now it's in 134, 135. So it's about a 60% fib retracement. So there's multiple different levels here that make sense. And then the candle pattern as well. So there's 2 or 3 things to me that shows that maybe this has peaked as we speak this week, the first week of August. So yes, it could get better, but I think this is a really good time to lock in one of those refi rates as they've gotten back down to where they were like 5 months ago. But then another reason is big picture economy stuff that we've talked about in some of our other videos. Check out the Bitcoin video, check out the crude oil video, check out the Aussie dollar. I think the crude market is starting to turn over. That's not a good economic indicator for the country for the next year or so, or the economy in general. S&P still at all-time highs. I get that, but it keeps slowly rolling over, barely making new time highs. I think the S&P is going to roll over. John, of course, is short in this trading account along with crude. So if we're right about crude and oil going down, and if this looks like it's kind of topped, the 10-year note is topped, that's like a triple play of reasons why you want to refi now and not wait. And once again, you might get a slightly better rate a month from now, but I think the risk-reward is not good. I think this is about as good a time as I've seen in the last year or so to refi. So if you've been thinking about it, don't wait any longer. You could refi. If you got a 30-year a couple years ago, you could refi it at a 15-year now for the same payment, basically. It's insane. And you're taking off 10, 12 years off what you're going to owe. It's just insane. And, if you've got cash, if you own properties with cash, you probably want to think about refinancing because you could use that cash elsewhere right now. You could refi at less than 2% on a 15-year and put it into a trading account and do what we're doing right now and make a lot more than 2% a year. So there's, even if you own something in cash, it's worth refining, in my opinion. So lots of ways to play that. I think the time is now. And once again, we're not financial advisors. We're just telling you what we do with our own money. And John has proven what he does with his own money with this $50,000 trading account where we're short crude, short S&P, long Aussie dollar, and all of those also would not be good economic indicators. And now you look at this 10-year, I don't know if now's the time if you're going to pull the trigger or not in the next day or so, John, but it looks like it's starting to roll over here. I know you're getting excited with that candle today, and I laid out 2 other. There we go. I laid out 2 other reasons. I always talk I like to look at multiple support resistant levels on weekly, daily, monthlies, but I also like to look at different reasons. And here we have an engulfing candle, which is bearish. We have a 50 to 60% long-term retracement back to this spot. We had a gap fill retracement over several months. These are 3 powerful things that makes me think this has been exhausted. And also, it's basically at a record level now where it was 5 months ago. So lots, once again, the risk reward to the downside is really good on this trade, and that's how we set up all these trades.
And the sentiment down here, it's a faint line. It's similar sentiment to what I use in NFL.
Yeah, look at that.
The betting community. You get too many bulls, on a team, and lo and behold, the unsuspecting underdog defeats the favorite that everybody loved. And the same thing applies in the markets. It's exactly the same. In concluding, Steve, I wanted to mention that each contract here is $100,000, but you don't have to put up $100,000 to control the contract. You're putting up roughly about $1,500.
Right.
So as Steve was talking, I actually, for our account, which you'll see because we want to be transparent with this thing, I shorted 5 of the September 10-year notes at 134. I'm trying to see what it was. 134.28, I believe, is what the price was. So 134 and 28 30-seconds. Every 30-second is worth $31.25.
So based on 1,000, so it's 1,000 divided by 32.
Yep. So if you go down, because you're controlling a $100,000 bond right now, so if that drops a point, that's $3,125. So that's where, and we started to show off that this is not for the faint of heart. Bonds are not, the Series E bonds that your grandparents got for you. These are the real McCoys, and they can and will rip your face off if you don't know and are not prepared to trade it the correct way and the prudent way. So again, Steve says you always want to check with your financial guy, your financial woman, your financial team, and make sure that this is suitable for you to do, because it's not for everybody. But for Steve and I, who also do the professional sports betting end of it, they run hand in hand. There's really, and on a high level, there's very few differences.
And here's something I will say, the Prez, we talked about this last week on Wager Talk Today. The Prez said, don't ask your financial advisor. We're talking about Bitcoin. He goes, because they'll tell you not to do it. And I was like, I get that point, and that is a problem, because we say ask your financial advisor, and 99% of them are going to say don't touch Bitcoin, because they're not traders. They're looking at a 10, 20-year hold. And to be honest, a lot of them don't get it. I don't want to knock financial advisors. I think they serve a role. I think the number one role they serve is to keep people from harming themselves. And a lot of people betting on Bitcoin would harm themselves, just like people betting on sports would harm themselves. But they're also going to tell you don't invest in sports betting. But if you followed me and John for the last 30 years we've been doing this, you've made a lot of money following our advice in sports betting. That's a form of investment as well. So, take everything with a grain of salt. Educate yourself would be my number one thing. Once again, don't do this blindly because we're talking about it. But keep in mind, when you ask your financial advisor, I'm kind of contradicting what I say every show here, but they are going to probably tell you don't do any of this stuff. So just keep that in mind, that they're looking at things a little bit differently. So also, I looked at the average trading range over the last couple months on a daily basis. This moves about 30 seconds. So that's what $500 on average is the average true range, because it's based on 1,000. So it's not too volatile. So when you have 5 contracts, as you just traded short, John, we're looking for an average swing, good or bad, on average of $2,500 a day. So, that put that in perspective, money management wise. And I think the easiest way for most people to play these are with the ETFs. And we're talking about a 10-year. The 10-year and the 30-year bonds, ZN is a Zulu November is the 10-year, and then Zulu Bravo, ZB,
is a bond.
Zulu Bravo is the 30-year. What's interesting, though, the ETF markets, everything's a 20-year. And I don't know for sure, but my guess would be that's because they're probably using both 10s and 30s to make the market, but or to make the fund work for them. But TLT is the big one. Tango Lima Tango. TLT is the big 20-year ETF, probably the most liquid one out there. I follow it. But, of course, now we're looking to short that. So instead of shorting an ETF, which can get a little pricey, I'd recommend using an inverse. And there's several out there. The 2 most liquid is a 1-time and 2-time short 20. The 2-time short is actually the most heavily traded. Volume of over 4 million a day. So that's a very liquid fund, and that's TBT, Tango Bravo Tango. TB as in Bravo Tango. That's a 2-time leverage short. And if you want a little less risk, The one-time lever, by the way, is TBF, Tango Bravo Foxtrot. BF, Bravo Foxtrot, TBF is the one-time short. But, once again, a little leverage isn't a bad thing. And keep in mind, it's all priced in. I'd recommend the two-time short because you don't have to put up as much capital out of your trading account. And if you manage your stop losses correctly, it's the exact same risk. We talked about this on some episodes yesterday. Bears repeating. One of the reasons financial advisors, 99% of them are going to tell you not to mess with this stuff is because leverage is involved. And they are scared to death of that word. And that's, once again, why a lot of them are good people, but a lot of them don't fully understand what they're doing because, that'd be like telling you never mess with fire again the rest of your life. So that means you can't cook food at a campsite. That means you can't, heat your house. It's like fire can be very deadly, but fire also allows us to live life. And leverage can also be very dangerous, but we have stop losses on these trades. If you have a stop loss, maybe one time out of 1,000 when you get that hard spike down and it breaks through your stop loss, you're going to lose a little bit more than you're planning, but that's always going to happen. It can work to your benefit in the long run as well. These gap opens, gap closes, if you have a disciplined trading style, they're going to even out, in my opinion, in the long run. It's going to be a wash. A two-time leverage short here, the one we're recommending, the TB Bravo T Bravo T, allows you basically to keep more money in your trading account and not just tied up in holding the ETF. So they're going to move exactly the same. In fact, I'm looking at the daily performance of these. The one-day change in the TBT is 0.12. The single one is 0.06. So they're doing exactly the same thing, and you don't have to tie up as much money. So our trade would be TBT. You're long because it's an inverse short. Here we're getting complicated again. But what's cool about this one, John, is if this one actually does show you what the interest rates are doing, because it's the inverse. So when it's going up, that's the rate going up. When you see it going down the last couple months, that's the rate going down. The refi rate's most likely going down. And so you look here again, there's a little bit more they could go, but you're pretty much at a bottom for a multi-year bottom now. So, it's a great, look at that one. I mean, you're getting down to the bottom. 4 or 5 months ago was a lot higher. So now's the time to refinance, and now's the time to look to go long this inverse ETF as far as a trade. And you got a good 50% retracement coming. You can make some good money. You put your stop loss below that big green candle there on the right, that one-day candle. Let's put a stop loss, maybe a point or two below that, just so the pros don't trigger our stop losses, which they love to do. And if it holds, that's a great sign. If not, then you get out. And you look for another trade. But and look at that trend line too. It's almost about anything up is going to break that trend line. Once it gets over that red candle from 3 days ago, that's going to pretty much break the trend line. So I put that as your entry point maybe in a couple days. If it breaks that trend line, that's your go long this inverse ETF. Set your stop loss a little bit below the low. You're talking about only a couple points of downside, and you're talking about a lot of points of upside reward. Once again, reward with risk. Risk reward is so good on this one. And it makes a lot of sense for numerous reasons, especially if the economy is going to eventually start slowing down. There's so many things we've talked about in the other videos with crude, the S&P, the potential shutdowns again, COVID. Let's not forget we're in August. I think we could all agree the fall and winter is not going to be better for COVID, flu, or any kind of outbreak of disease. So if it's not, if they're having problems in August right now, when everyone is outdoors still, that's probably also not a good big picture barometer of the economy and stuff that could happen. So risk reward is looking really good on these inverse 20-year bond ETFs. And the one we like there is TBT, Tango Bravo Tango.
And that'll get put into the portfolio. Probably, 200 shares to start.
Well, you're already short the ZN.
It's duplicating it, but
so we're short it now. It'll move the same.
We'll track it just for people who are interested in the ETFs.
We're just trying to keep something that's already a very complicated conversation a little simpler with the ETFs. But even then, an inverse double leverage, that's getting complicated for some people probably. But the one thing about the ETFs real quickly is the reason I want to bring this up. We talk about financial advisors. Another problem is 9 out of 10, if not 99 out of 100 of them can only buy stocks and bonds. And when we're talking about bonds, we're not talking about the 10-year note contract, the ZN, the Zulu November, because they can't do that. They can't buy commodity markets, future markets. So this ETF, the TLT, they can all own. Some of them, maybe 3 out of 10, can't do inverse ETFs. They can't do levered ETFs. I mean, that's where it gets so silly. It drives me crazy because if done responsibly, there's no difference doing an inverse or a levered ETF. There's just no difference. It's the same as a stock or anything else. But you're going to have some funds that can't buy a inverse ETF, and they definitely can't buy a 2-time levered any ETF. So it is what it is. But you got a good shot here with these ETFs with the 1 or 2-time levered. You can't do a levered ETF, then you do the TBF, Tango Bravo Foxtrot, because that's a one-time. It's an inverse. Maybe they won't let you do an inverse, but it's not levered anymore. So, but you can own these, and it's a good little hedge probably as far as, if you own a lot of stocks and other bonds. So the ETFs are much more doable for the average investor and long-term holder and stuff, or financial advisor. Mention it to them. Hey, if they don't get it, give them a link to our video. They can email me or John, and we'll get them on. I'll tell you what, I'd love to have someone on here to debate us about this, why it doesn't work for their clients, because I guarantee you they don't probably fully understand what we're talking about.
In most cases, that's probably true.
Yeah,
risk is defined by, it's kind of like risk is defined by the media. They make these things, options. Well, the most conservative trade in the world, and we can end on this, is not buying 100 shares of Apple or any stock. It's buying 100 shares of Apple and then selling a call option above the price that you bought it. And that reduces your risk by about almost 50% over the course of that option life. So that's another strategy we can talk about at another time. But
yeah, that's the ultimate risk management. I mean, it's a 100% definition of what you... Well, first of all, just buying an option in general, you can't lose more than you've paid. That's done. You can never lose more than that. But then you do a spread like you're talking about, you lose even less. It's locked in. It can't go any other way. That's a great analogy, John, and I bet hardly any financial advisor ever uses an option. I've never heard of one using them. And they get complicated also. So not a coincidence. They get a little complicated. But you're right about that. I mean, that's the definition of risk management. You cannot...
Definitely.
It's like making a sports bet. You can't lose more than you put on that game. You either lose it or you win, but you can't lose more than it. There's no action points or anything.
The difference between the sports game is with the option, it's unlimited upside.
Upside, correct. The reward, risk-reward again. Unlimited reward, 100% defined risk, which is even more than we're talking about in these trades. Because like I said, it could bust through your stop loss in a day or so. You could lose more than you plan. Very rare, and in the long run, it evens out. But yes, you could have these gap downs, like with these gap opens can definitely blow through your stop losses in the stock market or the future markets. But and that's another thing by the way, the Treasury note. Monday through Friday, they're only closed for an hour. They're open 23 out of 24 hours. So it's very unlikely something that liquid is going to, between 5 and 6 Eastern, that some ground-shaking news is going to happen worldwide between 5 and 6 p.m. Eastern time, especially overseas, because that's the middle of the night at that point in the bad
areas. When Asia's starting to open.
Right. So it's very unlikely with a contract like the ZN that's going to happen. Bitcoin, we've talked about, Bitcoin is that it gets dicey because they're down for 48 hours and the cash market is still moving. And I've got some theories on that we'll talk about on another show that we've kind of hinted at, that I think there's some stuff going on with the futures contracts on Fridays where they're doing stuff knowing they can move the cash market and then have a gap open. Because the futures contracts is a small enough universe where, think about it. If you can move the cash market, which is tough to do, there's only a handful of people that can do it, but we know one of them. His company is TLSA on the exchange. But think about it. If you can move the cash market over the weekend, you buy the futures contract on Friday before the close, you get back in like it did the 2 Sundays ago, it gaps up 5,000 points on a contract. That's $25,000 on one contract. So I don't know. That's just my theory. I think there's some funny business maybe going on with that.
And I will ask on the Manny's Pub Show, 4 o'clock Eastern Standard Time, Monday through Friday. We have the Tony Finn Financial Word of the Day, and I have a bunch of them now that just kind of came into me.
We got to start writing these down because we always forget them.
I mean, we have buy rights, we have straddles, we have strangles, we have butterflies, we have iron condors.
I know that one, yeah.
Yep. And I've traded every single one of them.
Give them a gap open. Gap open would be a
gap
good
open.
Or gap open. Yeah, they keep coming to me, and I got to write these down. You got to write all those down, John, because just the option market alone, all those ones for the option, the Iron Condor is a great one. He's got to come with an Iron Maiden reference or something.
Yeah, I'm sure he will.
Would be the first thing I would think of. But the option markets have some really good one. I think we've given him Naked Short, of course, which is just low-hanging fruit, although he's been very responsible for the ones I've given him, so I've been pleasantly surprised.
Well, if I could load it up and say, what's the difference between a straddle and a strangle?
Yeah, that's probably a good one. Do that one today.
I will.
Do that one today.
Yep.
2 for 1 special.
Will. So that's I'll probably be around 420 when I get to that point, but it'll be fun. It'll be fun. That'll be an outtake for sure.
I like it.
All right, Steve. Well, thanks for your time. Another great show here, and people that are viewing this show, if you like it, give us a like and subscribe, ring the bell, and all that fun stuff, and we really appreciate it quite a bit. So for Steve Merrill, myself, WagerTalk.com, SportsMemo.com, and this Predictive Playbook series of shows, may all your trades be winners.